Welcome back to the Williams Real Estate channel. Today, real estate rants, or a lot of offcuts I've got. Couldn't quite put together a topic. It's a bit of a mismatch when my brain is firing. So we'll run through some of these and I'm sure you get some golden nuggets out of them. First one I got here is humans overestimate risk and underestimate opportunity. That's a Jeff Bezos quote, which I'm also always telling myself is instinctively humans look to be a bit more pessimistic, overestimate what the worst case scenario risk could be, and in doing so they're holding themselves back from making moves and not maximizing the opportunity upside. So always be conscious of that instinctively, if you're looking at buying a property or taking on debt or growing your portfolio, 9 times out of 10 there'll be more upside than the potential risks in doing so. So, I mean, even the banks factor in your borrowing power. So if you can get the money out of the banks, then you might as well put it in the market and keep growing and moving forward and not get gun shy over what the property looks like. If it's got, a bit of maintenance work, upkeep that needs fixing, if there's something wrong with it, whether it's a plumbing issue, a roof issue, cracks in the walls, all this type of stuff, it's part of the game. It's part of the territory when investing in property. There is risks involved, but there's also massive opportunity upside with the market. The market just does not wait for anyone. Next on the list, we have the money is in the refinance. This is a big misconception. People believe you go buy a property, eventually you'll live off the rental income. Yes, you can live off that rental income, but the money is in the refinance. If you can buy a property and after 2, 3, 4 years refinance it and borrow 100, 200, 300,000 back out of that, not only to reinvest, but then you can also use that like working capital in a business to then fund your lifestyle. And that's untaxed. Sure, you're getting into more debt, and on average 5-6% interest to the bank, sometimes more in the boom, sometimes in the slowdowns when they drop rates back down to near zero. Cheap money, but on average 5% to the bank is a lot cheaper than 25, 35, 45% tax to the ATO, depending on your tax bracket. So the money is in the refinance. And over time, property will continue to keep going up with inflation, and that same property inflation will devalue the debt. So $1 million worth of debt today, in 10, 20 years time will be worth 200 or 300 grand. So the debt becomes irrelevant over time with property inflation. When buying a property in an area, you are buying a piece of the market. So yes, you are buying the property with the structure on top, if it's a house or a block of units or individual unit, but the reality is you are buying a piece of that market. So the market will do, what I've seen, easy 90% of the heavy lifting. Sure, maintenance, upkeep, renovations, small developments is great, additions is all great to add to your portfolio, but 90% of the heavy lifting will come through from that market cycle. So timing the market well is crucial, because it can be the difference of allowing you to refinance and build your portfolio quickly and over a 10-year period, 10 plus properties, or it could be the market that can put you out for many years. If you buy peak market in the wrong asset class, like new and off the plan stock, pay a premium, it could put you out of the game for 5-10 years easily because markets go through cycles. On average, typically markets go through 10 years of stagnant flat growth, and then they'll hook through a growth cycle which can last 5 to 7 years, where they go up from trough to peak 180 to 200% if you can time it right. They'll then top out and then go through another stagnant flat period. So you want to get into the markets after 7, 8, 9, 10 years of stagnant flat growth, because it can be any time where it just hooks and goes through a growth cycle. So that brings me to another misconception, is people tend to look in the rearview mirror and they say, okay, well, this market's booming like Brisbane is now. It's got the Olympic Games coming up. They think that's now a good time to buy into Brisbane. It's not. You want to get into markets when it's been stagnant flat for many years, because that's when you get the growth. You're buying the future growth, not what has been historically. So don't get caught up with the fear of missing out and the FOMO, because that can be dangerous. Now, getting into Brisbane now, Perth, Adelaide, some of the regional towns can be dangerous now, because they've gone through extraordinary growth over the last 5, 6 years, and they're reaching a top. At some point they'll hit a top, they'll soften and then go flatline for many years. So you don't want to get into that. You want to get into markets before they go through that significant growth cycle. Inflation is good for property investors. This brings me back to my previous point, but inflation continues to erode the currency. You need more currency to buy the same property. So the property that was built in the 50s, you need more currency to buy it. So you can hedge your wealth. Best time when there's high inflation is to buy property, because it'll continue to keep going up in value, and over time your position gets stronger as inflation erodes the buying power. So the debt you use to buy the property will get devalued over time, and the asset will continue to increase in value. So property is a great hedge during times of high inflation, and inflation is actually good for property investors. It's not the property that goes up in value, it is more so the currency losing its value. So that's, again, another point to resonate on. It's actually the currency that continues to lose its buying power, which makes it, you need more currency to buy the same type of property. Unpack infrastructure. So infrastructure is great. New roads, tunnels, metro lines, upgrading stadiums like what they're doing around Brisbane now for the Olympic Games coming up. There's a good book you may want to read about, is Taken for a Ride. It talks about how the public investment from the government into new roads, tunnels, train stations, metro lines ultimately soaks down to the benefit of the land price around that investment going in. So if the government's spending billions of dollars into infrastructure, those gains are received by the people who hold property within a close proximity to that investment being deployed. However, it is not the be-all and end-all. The market will do 90% of the heavy lifting. So infrastructure is great, like what's going into Brisbane now. Every capital city has massive infrastructure. You've got the Melbourne Loop project, you've got the Sydney Metro project, you've got the Coomera Highway going up between Gold Coast and Brisbane, you've got the Cross River Rail project in Brisbane. They're putting a metro line from Brisbane down to that Logan region. It's all great. It's all fantastic. It all helps with gentrifying a suburb because it allows people to commute quickly to the CBDs. But it's not the be-all and end-all. It's not a reason to get into a market. It's like the icing on the cake. You need to bake the cake in right from the start and let the market do the heavy lifting. And then if the government's putting infrastructure into the region, happy days, but it's not the reason to invest. Classic example now is a lot of people are ploughing into the likes of Queensland, Brisbane, because of the Olympic Games, because of all the infrastructure spend. That's great, but you need to get into that market 5-6 years ago. The market's already done 90% of the heavy lifting. Sure, the infrastructure will give it a final sugar hit, along with all the capital that will come in during the Olympic Games. But after that, it'll switch off, go through a downturn, and then go flatline for many years. And you don't want to be buying peak market, because you are buying the future growth, not what has been historically. Understanding oversupply and undersupply. So every market goes through oversupply and every market goes through undersupply. It's a classic property cycle. It starts with an undersupplied market, like what Sydney and Melbourne are today. They're undersupplied. They went through a big boom from 2010 to 2017, topped out, started to stagnate. Prices softened. Developers stopped building as much stock because nothing's feasible. Cost now to build $600,000 minimum to build a unit. So it needs to be selling for $700, $800, $900 million bucks for there to be profit in the job, for jobs to be feasible. So a market starts by being undersupplied. Demand continues to come in with growing population. That puts pressure on prices, puts pressure on rents. That makes yields attractive. The yields become attractive. That then draws investment into an area. That yields then push up prices. So rents rise first, then creates attractive yields. That brings in investors and people looking to live. Prices then follow. Once prices then follow, projects then become feasible again to then build. Like what we're seeing now in the likes of Brisbane, Perth, Adelaide. These markets have gone through their balanced market and now in the boom, where prices rise above the build costs, 600,000, 700,000. That's when developers start building again, releasing more stock to the market. Come a peak market, that's when you usually see new and off the plan, house and land packages all flicked, sold pre-peak market. As developers typically need, if they're going and getting the finance from the bank, minimum 50% pre-sales. That's why they need to sell at least half of the stock off the plan before they can get the funding to finish the jobs. Hence why they get all the property spruikers to push their stock with all the shiny brochures. Then they release all the new stock onto the market. Typically come peak cycle, then there's an oversupply, too many properties versus how many buyers are in the market, and then supply and demand. Too much supply, not enough demand, prices then soften, go through, and then goes through a downturn. So classic property cycle starts with undersupply, becomes more balanced, goes through a boom, all the stupid money likes to pour in then developers then start building and releasing stock to a market, and then it goes through a downturn. So typically you'll find how developers also study the markets is they buy sites during the downturns, the slumps, like in Sydney, Melbourne now. They typically hold them for 5 to 10 years until the market recovers and then booms, and then they develop the site and sell the stock into a rising market in the boom to get the profit. They don't buy peak market and do the opposite. So be greedy when others are fearful, and fearful when others are greedy, is a classic quote from Warren Buffett. So hopefully that explains a little bit more around how the general property cycle works. Next is on how to make the best deal, how to buy the best deal. There's many ways to skin a cat, but this is typically how I like to do it. Is firstly, you need to find the best market to buy in. And the best market to buy in are the suppressed markets. It's a bit counterintuitive to what you would probably think. Like most people, even buyers agents, are pushing people into the likes of Brisbane and regional Queensland and Perth and regional WA and Darwin. But those markets are booming. And sure, to the mainstream, that may be a good idea, but it's not. You want to get into markets that are more suppressed, not right at the start of their downturn, but after they've gone through a downturn, they've then started to stabilise, and then they stagnate for a good 3-4 years. Then they'll hit a bottom, a trough, and then it's only a matter of time they'll just run. That's when I like to get in to markets once they've gone through their downturn, they've stabilised, and then they're starting to stagnate. At that point of time, typically is the time when a market is getting the most negative sentiment from mainstream media, mainstream people at barbecues. Why buy in that market? Because it hasn't gone anywhere in so long. Was the commentary we were hearing around Brisbane in 2018, 2019. That's when we were buying up heap. Same commentary we're hearing now in Melbourne. So every market has its time in the sun, and it's a matter of timing the markets well, getting into markets when they're primed for the next growth run. So that's number one, getting the market at the right time. And how I do it, I mean, there's many ways to skin a cat, and it's quite interesting now seeing all these other investors buying in certain markets. And they derive to their conclusion through different ways. But how I like to do it is I use the 18-year land cycle framework to work out where we firstly sit in the market, being equivalent point of time in the prior cycle 2006. And then from that, I peel back the layers, run the historical sales data reports for every market across Australia and see how each market performs historically, which will then allow you to paint a picture of where they sit moving forward. So history doesn't repeat exactly, but it rhymes, and it's the best way I've found to correlate when markets are due to run, using the historical sales data, using the 18-year land cycle, using yields, because yields are also a good way to show future growth, because yields become attractive, prices then rise after. So getting into the right market, firstly, you can use multiple different metrics to work out which is the best market and timing. Building relationships with agents, because ultimately the agents will get you the stock, unless if you're going to go door knock yourself. Get deals off market or pre-market, so then you're not competing against the masses. And ultimately agents just want to move the stock. They're a commission model. They would rather sell it, quick deal, move the stock, than campaign it for 2, 3, 4 months to get an extra 50, 100 grand more. A bird in the hand is worth more than two in the bush to an agent, so they will want to close the deal. So work your agents, find the deals off market, pre-market. But sometimes when a seller is just about to put their property to market, at that early stage, that is sometimes when you don't get the best deal. Sometimes the seller needs to get a dose of reality, especially if they bought it prior boom and they need to sell it at a loss. Sometimes they need to understand what the market value is of their property, and sometimes it needs to sit on the market for 40, 60, 90 days before they'll let it go. So depending on the seller's circumstance too, you can work that out. If they need a quick sale, if it's a mortgagee sale, or if it's an older owner who's owned it for many years and they don't quite understand what the current fair market value is, because I can tell you some agents won't educate the sellers on that. Work the agents, work the sellers, understand what their motives are, and if they're a motivated seller, if they are, then great. And then you can work the agent, lowball, get a counter, play the game, work back and forth to ultimately find a middle ground and cut a deal. And I always like finding the properties that have something wrong with them, because you can quantify, okay, it needs a new roof. That might be a 100 grand bill, but it's split between 10 unit owners, so it's 10 grand bill. Or it might need a new bit of plumbing works, if it's old terracotta pipe work that needs to be dug up and replaced, you can work that out, linear meter. If it's got hairline cracks in the walls, needs a bit of patch and paint, needs a bit of love. If it's got something wrong with it, typically that will then deter a lot of other buyers. But if you can quantify how much it would cost to fix that, take that off the price, and then typically you'd be able to get 30, 40, 50 grand more off the price by negotiating well with the agent, who's then also pushing to sell it because they want to get the deal done and off their books. So typically when there's something wrong with a property, that's when you get the best deal. And provide you're pricing it in, you quantify it, take it off the price, and you can make money on the way in, and then fix it, and then that gets rid of the issue, and then you've got a great property, well under market, building in equity from day one. So that's typically how I like to buy property. So find the best market based off the cycle and other metrics we like to use. We like to work with our established relationships with the agents to get the deals, even the deals that need work, even better. Low ball, get a counter, go back and forth a couple of times until you meet somewhere in the middle. And then don't be shy of putting multiple offers out. Just like fishing, you throw 5 lines out, one of them will bite, and then when you can play off a couple of different properties, have a few offers out, you're not emotionally involved or attached. If they don't sign it, who cares? There's always plenty of deals to be had. And I think that is to the end of my notes. Hope you enjoyed that. Until next time, thanks for watching.